As investment professionals, we need to learn from every crisis so that we can be better prepared for the next crisis, so as to protect and preserve our clients' wealth. What have we learned so far from the global COVID crisis, or as I will refer to it, the GCC? Well, for starters, this has been one of the most severe downturns we have seen in our lifetime, and it is being likened to the 1929 Great Crash. But one of the big differentiators is that we didn't see it coming. When you look back at the 2008 financial crisis, there were many warning signs. There were many indicators, financial indicators, that were telling you there is stress building in the system. Be careful. But prior to the GCC, there were no traditional warning signs, and the market's reaction was incredibly fast. This crisis took 35 days for the market to plummet 35%. In contrast, during the 2008 financial crisis, although we fell further, it took 360 days from the top to the bottom. What we found very puzzling is that the fall felt to some extent dysfunctional. We believe this is due to a structural shift in the makeup of our equity markets. We are active managers, which means we discover price. Price discovery is simply one active manager trading against another. Now, what is happening on a global scale is more and more money is moving into passive investments. The strategy of the passive investor is very simple. They follow price, but at a lower fee than an active manager. If we continue to have more passive managers and less active managers, we are going to get more volatility in our equity markets. And this presents us with great opportunity. Because if you have passive investors who are making investment decisions, but do not possess the in-depth understanding of what price they are actually transacting at, then the active manager is going to trade against them. So just think about it. If we had no active managers, not one, how would the passive industry follow price? How would they create price? They don't have the ability to create price. This is something that is developing around the world. In the US equity market, almost 40% of AUM is now managed by passive investors. Michael Burry flagged this some time ago, saying, "Listen, when these passive funds unwind, it is going to be disorderly." And that is exactly what happened during this downturn. As active managers, we must adjust and we must seek the opportunity in the structural shift.